Crypto is famously volatile, but it's not every day that two of the largest crypto projects just fall apart and become worthless overnight. That's right, today we're talking about Terra and how both Luna and UST's value disappeared in a flash. Welcome to Crypto Made Simple, the best place to learn everything you need to know about crypto. First, to make sure we're all on the same page, let's quickly go over a few definitions and concepts that will be handy for understanding what exactly happened to Terra. Let's start with this article's Big 5. Terra, Luna, DeFi, UST, and Stablecoins. Terra is a cryptocurrency platform by Terra Labs, whose token is also known by the name Luna on the markets. If that's confusing, it's the same as when Tesla is known by the ticker TSLA on the stock exchange, just not as recognizable. The Terra platform is a public blockchain deploying a variety of algorithmic stablecoins, but don't worry, we'll explain that in just a bit. Terra acted as the connecting hub between all other blockchains, creating stablecoins, paired between Terra and any other cryptocurrency, but we'll explain that in more detail shortly. The main benefit of using Terra over the original blockchains was the reduced fees compared to the traditional way of swapping through exchanges. Initially, Terra aimed to be the platform that decentralized finance, also known as DeFi, would be brought to the masses. DeFi is a new way to conduct financial trading without a middleman, removing both fees and the requirement of trust between participants, which are just an electric agreement written in code. The main benefit is that once both individuals sign, the smart contract cannot be changed or cheated, and executes automatically once the pre-agreed criteria have been met. DeFi doesn't need any centralized body like a bank or government to operate it. As in DeFi, the users host the platforms and products themselves. Terra USD, more commonly known as UST, is the stablecoin of the Terra ecosystem, which is supposed to be tied at $1 like other stablecoins, such as Tether or USDC. But unlike other stablecoins, UST wasn't backed by a tangible asset like the US dollar or gold. Instead, UST relied on a system of minting and burning Luna/UST to maintain that $1 price tag, keeping it stable. Let me explain minting and burning. It's best to think of minting as another word for creating, and burning as another word for destroying. Whenever a crypto asset is created, it is minted. Whenever it is sent to an address that can't be recovered, it is burned. Through a complex process of minting and burning Luna for UST or vice versa, Luna was able to find utility, and UST maintain a peg to another asset without anything else being held to maintain its value. That is what we call an algorithmic stablecoin, and is what made Luna different from most other stablecoins on the market. But hold on, what exactly is a stablecoin, and how can buying and selling Luna help maintain its value? A stablecoin is an asset connected to the value of another currency, commodity, or financial instrument. Typically, these cryptocurrencies are tied to a regular currency, mainly the US dollar. If the asset is connected to the US dollar, like UST, its peg would be $1. Think of it like when you're hanging your laundry up to dry. You peg or hook your clothes to the line. The same is happening on the blockchain, except instead of pegging clothes to laundry lines, they peg their cryptocurrency's value to an external asset like the US dollar. Typically, for other stablecoins on the market, there is a physical reserve like cash or gold. Let's look at a currency-backed stablecoin like USDC. When USDC needs to restore their $1 peg, they just buy or sell physical assets until the balance is fixed, and its base savings match its market cap, or the total invested funds. In plain English, if USDC has 50 billion invested into its platform, it needs to have 50 billion in the bank. The main benefit of stablecoins is they're supposed to always maintain that value. Since cryptocurrencies can be volatile, stablecoins were designed to allow easier trading when making crypto payments. Typically, stablecoins are cheaper to use and transfers can be completed much faster than Bitcoin. As good as Bitcoin is, we're unlikely to enter a world where Bitcoin is used for payments. People probably won't wait 10 minutes after making their Bitcoin payment to see if the transaction has been completed or not. It can be annoying to try and use certain cryptocurrencies for purchases. For example, if you believe you had $100 in BTC, but BTC devalued in the 30 minutes you were shopping and now you only have 90, you might find yourself red-faced at checkout when your card unexpectedly declines. These scenarios are the types of use cases stablecoins look to solve. But unlike other stablecoins, UST didn't buy it and sell an asset like gold to ensure their value was always at the matched value. Instead, UST tried to use Luna, which created an opportunity known as arbitrage. In short, whenever UST was above or below its intended $1 value, this unique arbitrage opportunity was created. On the Terra network, you can mint a $1 UST token for $1 worth of Luna. So say UST was up to $1.01. You could go to Terra and create UST for only $1 worth of Luna. Then you could sell that UST token you've just created on the open market for its market price of $1.01 and keep the profit. This process worked both ways. So suppose we imagine UST was down at 99 cents. In that case, we could buy lots of UST on the open market and go to Terra to exchange it for $1 worth of Luna tokens, creating another small profit. This ensured that the UST price was always maintained at the intended $1 price point, because as soon as a fluctuation from the peg appeared, there was an opportunity to create safe and easy profit, which traders always took. But okay, and now you know Terra is the name of the crypto platform, its native asset is Luna, and its stablecoin is known as UST. So how did it all go wrong? Well, it wasn't like Terra's creator wasn't warned as far back as November 2021 about the potential for a Black Wednesday style attack. Black Wednesday refers to the day George Soros broke the Bank of England by betting on the value of the British pound falling. Soros then sold lots and lots of pounds to ensure it happened, scoring him around $1 billion in a single day's trading. Unfortunately, instead of listening to this advice and thanking the person for highlighting a flaw in the protocol, Terra Labs founder Do Kwon instead said in a Twitter post that it was one of the stupidest things he had read this decade and encouraged any billionaire who saw this to try. It looks like one of those billionaires decided to call his bluff. Presently, a full investigation is still underway. Still, according to initial reports, it all started on May 9th, 2022, with a massive sell-off on Curve, beginning with an 85 million UST to USDC swap that had the liquidity pool slightly out of imbalance. But let me quickly explain. Curve is a popular crypto platform that trades stablecoins through liquidity pools. And a liquidity pool is a crowdsourced pool of cryptocurrencies locked under a smart contract. This is used for providing the capital, known as liquidity, for trades. These liquidity providers receive a bonus that often include a small percentage of the transaction fees in liquidity pool tokens, which can later be sold on the open market. But back to Luna. To put the Curve pool back into balance, 50,000 ETH was sold and another 20,000 ETH was sent to Binance. Although the first defense was successful, the UST value is now moving between 0.987 and 0.995. This led to a $2 billion withdrawal of UST from Anchor. Anchor is another Terra Labs project that offers nearly 20% annualized returns on investment for locking up UST to their blockchain for a year. But like all Terra products, Anchor protocol is also now down 99% from its all-time high. Regardless, it appears as if a person or group got together and secured a $1 billion loan from an exchange, which they used to short the price of either Luna or BTC. This act of shorting is essentially betting on the decline of an asset's value, and if you're right on the pre-agreed date, you stand to make a lot of money. Using this loaned amount, the attackers managed to drain the entire 350 million balance of the Curve liquidity pool, creating even more panic. This caused a significant problem as those seeing the value of UST drop were looking to sell their UST, but now there's no liquidity for trading to go through. The panic intensified. Using the remaining 650 M, the attackers began to slowly drop all that UST onto the market. This pushed the price down even further as outside investors believed it was a mass sell-off and followed to avoid being stung later by falling prices. Soon, a self-fulfilling cycle emerged to the point where Terra Labs was forced to step in and start selling their BTC reserves to try and restore the UST peg. But here's the second major problem the Terra ecosystem faced. When two assets are highly correlated, meaning the values tend to go up and down together, like Bitcoin and Terra, you face a unique problem. Generally, the market follows Bitcoin, and if Bitcoin is down, typically the rest of the market is too. So by selling large amounts of devalued Bitcoin, as Bitcoin is currently down around 50% from its all-time high, you're making a lot less money than expected. Maybe even worse, you only increase the downward sell pressure on Bitcoin, worsening your situation even further. As if Terra, Anchor, and your Bitcoin reserves all failing wasn't unfortunate enough news for one day, further misery was caused by the cashing out of UST into Luna. This crashed the Luna price because no one was willing to sell their devalued UST. So the only option left was to burn it for the $1 Luna value. This created a lot more Luna available on the market and lowered the price as supply exceeded demand. More panic ensued, with more people desperately trying to exit their positions. This eventually leads to a death spiral, or where there is an unstoppable cycle of downward pressure until the system collapses, which is what we've seen with Terra. Trading for around $60 on May 9th, by May 11th, 2022, Luna had fallen to 83 cents, and then again to just below 0.002. To give you some context, famous YouTuber KSI had $2.8 million locked up in Luna, which ended up being worth less than $1,000. This is how extreme this fall from grace has been for Terra and all of its holders. But what does this mean for the future? Likely in the short term, it will be a rough ride for Terra Labs and holders of its products. If Luna or UST is to survive, it will take a significant change to the algorithm and a long time for consumer confidence to be restored. It's hard to say if this is the end or if it'll be like the fork we had in 2016 that led to Ethereum, as we know it today, and Ethereum Classic. Presently, it looks as if the founder Do Kwon is just trying to construct a rescue plan, but given that his arrogance was partly responsible for this situation, it's hard to say if consumers will return with the same intensity as they exited. Currently, the recovery plan consists of a governance vote that began on May 18th. Right now, roughly 154 million votes have come in, with 80% of the votes in favor of the hard fork option. If the vote ended in its current state, the fork would go through. A hard fork is when a blockchain splits in two. The original blockchain will continue as it's currently, and the forked version will be updated with the patches that fix the issues. If this hard fork occurs, the current Luna tokens will be converted into LUNC and become known as Luna Classic. This is very similar to the arrangement that happened on Ethereum in 2016, which gave us the two Ethereums we mentioned above. Holders, investors, and developers of LUNC will be rewarded with brand new Luna tokens on the new fork network. If everything goes to plan, the new network will be launched on May 27th. And that is the story of Terra, what it is, how it worked, and why it disappeared, at least for now. That's all for today's video. If this video was helpful, or if you'd like to know more, go check out more of our videos at Crypto Made Simple. And don't forget to leave this video a like and subscribe to see more. Thanks for watching.